Lancia enters 2026 carrying the weight of nostalgia, strategic hesitation, and prolonged underinvestment. Once synonymous with rally dominance and technical ingenuity, the brand now stands as one of the most fragile assets inside Stellantis. The gap between its historic prestige and its current financial relevance has widened to a dangerous degree. For more than a decade, Lancia survived almost exclusively on the domestic Italian market with a single aging model, the Ypsilon. Unit volumes were modest even in peak years and geographically concentrated. That concentration shielded the brand from immediate collapse, but it also prevented meaningful scale. By the time Stellantis was formed through the merger of Fiat Chrysler Automobiles and PSA Group, Lancia had already lost its European footprint, dealer density, and engineering independence. The relaunch plan presented in the early 2020s promised electrification, premium repositioning, and a gradual return to select European markets. On paper, this strategy appeared rational. In practice, it exposes Lancia to the most capital-intensive and competitive segment in modern automotive history. Lancia does not operate with an independent balance sheet. Its financial viability is embedded within Stellantis. That structure offers temporary protection but masks deeper vulnerability. Stellantis manages a portfolio of brands including Jeep, Peugeot, Alfa Romeo, Opel, and others, all competing for finite capital allocation. When capital discipline tightens, weaker brands are deprioritized. The relaunch of Lancia requires investment in electric vehicle platform integration, battery procurement, new design language and interior architecture, dealer network reconstruction outside Italy, brand marketing across multiple European markets. These investments occur during a period of electric vehicle margin compression. Across Europe, manufacturers have been forced into pricing adjustments to maintain volume. Incentive reductions in major markets have dampened demand growth. Financing costs remain elevated relative to levels before 2022. Lancia aims to position itself as a premium electric brand. That positioning requires higher transaction prices. However, premium electric vehicle segments are already crowded by entrenched players with global scale and brand recognition. Competing against manufacturers that produce millions of vehicles annually places Lancia at a structural disadvantage in procurement leverage and cost absorption. If projected volumes fail to materialize, the fixed cost burden per unit increases. In a portfolio structure like Stellantis, underperforming brands create internal pressure. Return on invested capital becomes the decisive metric. Lancia must justify every euro deployed against alternative uses such as software development, battery factories, or core global brands. Lancia's dealer network outside Italy effectively collapsed during its years of contraction. Rebuilding that infrastructure is neither inexpensive nor guaranteed to succeed. Dealers operate on thin margins and are cautious about onboarding low-volume brands without proven demand. Re-entry into markets such as France, Spain, Belgium, and the Netherlands requires physical showrooms, service capacity, training programs, and inventory financing. If early sales performance disappoints, dealer enthusiasm will erode quickly. Residual value performance will be a decisive factor. Used electric vehicle prices across Europe have softened since 2023 due to oversupply, technological obsolescence concerns, and shifting subsidy frameworks. If Lancia vehicles depreciate faster than segment benchmarks, leasing companies will demand higher risk buffers. That directly increases monthly payments and reduces competitiveness. Lancia's historic absence from many European markets also means weakened brand trust. Younger consumers may have little awareness of its rally heritage or luxury positioning. Rebuilding brand equity requires sustained marketing expenditure over multiple years. If budget discipline intensifies within Stellantis, such discretionary spending is vulnerable. Unlike its historic era of independent engineering, modern Lancia relies heavily on shared Stellantis platforms. The new generation models are expected to use modular architectures also deployed by Peugeot and Opel. Platform sharing reduces development cost but constrains differentiation. If Lancia's vehicles are perceived as lightly modified versions of Peugeot or Opel products with higher price tags, the premium strategy collapses. Automotive history demonstrates that badge engineering rarely sustains long-term pricing power. Design language alone cannot compensate for limited mechanical distinction. Battery range, charging speed, software integration, and driver assistance capabilities must match or exceed competitors. Achieving that parity requires continued software and hardware investment. Software development represents a growing capital drain across the automotive sector. Delays, integration challenges, and cybersecurity requirements have strained even larger manufacturers. Lancia's reliance on group-wide software ecosystems means any systemic delay within Stellantis directly affects its product cadence. Market conditions into 2026. The European automotive market entering 2026 faces multiple stressors: gradual reduction of electric vehicle purchase incentives, tight consumer credit conditions, energy price volatility, intensifying competition from Chinese manufacturers. Brands such as BYD and MG Motor have aggressively expanded into Europe with competitively priced electric vehicles. Their scale and vertical integration create pricing flexibility that legacy brands struggle to match. Lancia, positioned as premium, cannot compete on price. It must compete on perceived value. That perception requires flawless execution. Any quality issues, software instability, or supply delays would undermine credibility during its fragile relaunch phase. Furthermore, Stellantis itself manages significant strategic commitments across North America and Europe. If macroeconomic headwinds intensify, internal capital triage becomes inevitable. Brands with the weakest volume contribution and lowest margins are most exposed. Several measurable signals would indicate deterioration approaching 2026. Production delays or cancellation of announced future models, slower than projected dealer rollout outside Italy, aggressive retail discounting shortly after launch, workforce reductions in brand-specific operations, public statements emphasizing portfolio rationalization. Portfolio rationalization language often precedes consolidation or quiet discontinuation. Stellantis leadership has repeatedly emphasized performance accountability for each brand. That accountability framework, while fiscally responsible, places Lancia in a probationary position. The relaunch is effectively a test of viability rather than a guaranteed revival. Direct bankruptcy of Lancia as a standalone entity is unlikely in the near term because it is not financially autonomous. The greater risk lies in strategic absorption or termination within Stellantis. Three plausible outcomes exist: reintegration as a niche sub-label under another Stellantis brand, gradual withdrawal from markets if sales underperform, complete discontinuation to streamline portfolio focus. Historical precedent within the industry shows that conglomerates eventually eliminate underperforming brands when capital efficiency demands it. Emotional attachment rarely overrides return metrics. If electric vehicle adoption slows further or profit margins compress across the sector, Stellantis may prioritize brands with stronger global reach, such as Jeep or Peugeot. Lancia's limited geographic footprint makes it easier to sacrifice relative to higher volume divisions. Please subscribe to our channel. We want to hit 1,000 subscribers this week. Consumers evaluating a new Lancia vehicle must consider long-term ownership risk alongside design appeal. Service network density remains uneven outside Italy. Even with expansion plans, coverage gaps could persist for years. That affects maintenance convenience and repair timelines. Residual value uncertainty poses immediate financial risk. If the brand fails to achieve stable market recognition, resale prices may weaken. Leasing contracts could incorporate higher residual risk premiums, translating into elevated monthly costs. Software longevity is another overlooked factor. Modern electric vehicles depend on continuous over-the-air updates for performance optimization and security compliance. If brand-level investment declines, update frequency may diminish. That directly impacts vehicle competitiveness over time. Warranty backing ultimately depends on Stellantis' financial health and strategic commitment. While the group is currently solvent and diversified, automotive cycles are volatile. A downturn could accelerate internal consolidation decisions. Insurance pricing may also reflect limited repair network scale. Low-volume vehicles often face longer parts lead times, which increases insurer risk assumptions. Consumers should evaluate the following: dealer proximity and long-term viability, lease residual terms versus segment benchmarks, battery warranty specifics and transferability, software support commitments, public statements from Stellantis regarding brand investment horizon. The purchase of a vehicle typically spans 5 to 10 years of ownership exposure. Brand instability during that window can materially affect the total cost of ownership. Lancia's heritage, including rally icons such as the Delta Integrale, creates powerful emotional resonance. Nostalgia can influence purchasing decisions. However, heritage does not guarantee financial sustainability. The modern automotive landscape rewards scale, software capability, and capital discipline. Brands lacking one of these pillars struggle to survive independently. Lancia currently depends on group support for all three. If early relaunch models fail to achieve meaningful traction outside Italy, momentum could dissipate rapidly. Automotive comebacks require sustained volume growth over multiple product cycles. A single successful launch is insufficient. Approaching 2026, Lancia operates under conditional survival. It is not yet in open crisis, but it remains structurally vulnerable due to limited scale, heavy reliance on shared platforms, uncertain premium positioning, and exposure to tightening electric vehicle economics. Its fate rests less on brand storytelling and more on measurable financial performance within Stellantis. If return on capital falls below internal thresholds, strategic patience may expire. For investors analyzing Stellantis, Lancia represents a portfolio risk variable. For consumers, it represents a brand with potential aesthetic appeal but elevated long-term uncertainty. The next two product cycles will determine whether Lancia stabilizes as a profitable European niche brand or becomes another casualty of automotive consolidation. In an industry defined by ruthless capital allocation, sentiment offers no protection. Please subscribe to our channel. We want to hit 1,000 subscribers this week.